I've been saying silver is going to reach $28 in the second quarter this year. Here we are, we're 10 days in, and it's already at $28. Honestly, at this point, it's been quite the run up, both metals. A bit of a pullback would not surprise me at this point to digest some of those gains. I'm not saying it's going to be extended or deep, but I could see, perhaps some kind of a quieting or over a sideways move, small pullback over the next, say, week or couple of weeks. And I think that we're going to at least maintain and perhaps push higher. I think that the second half of this year could see us hit somewhere around $30, and I'm being conservative.
Silver prices soared to their highest level in nearly 3 years on Tuesday, echoing the upward trend in gold prices, which reached yet another record high. Silver prices comfortably traded above $27.80 an ounce, briefly spiking to $28.36 an ounce, marking the highest price since May 2021. The surge in silver prices has undoubtedly been fueled by the impressive performance of gold, which achieved a fresh all-time high of $2,365 an ounce on Tuesday. Analyst reports have also highlighted significant inflows into the silver ETF market in recent weeks, supporting the upward momentum in silver prices. Moreover, the weakening of the US dollar against other major currencies since the start of April has strengthened dollar-denominated assets like gold and silver. Despite gold's current meteoric rise, Peter Krauth points out that silver has lagged behind, only reaching half of its historical peak. While gold typically leads the way in price movements as the premier precious metal, Peter argues that silver offers unique advantages, including the potential for higher returns and increased leverage. Despite silver's tendency to trail behind gold's trajectory, Peter expresses confidence that it will eventually catch up and even surpass gold, a trend consistent with historical patterns observed in bull markets since the 1970s. Highlighting the recent challenges facing silver, Peter emphasizes structural deficits in the silver market as a significant factor affecting its price dynamics. He notes a substantial decrease in inventories across major exchanges and ETFs in recent years. This trend and robust industrial demand have prompted significant consumers to acquire silver actively, effectively constraining its price despite diminishing supply. Peter anticipates that silver could experience further increases in value, even though prices have recently sharply risen. He sees that there might be short-term fluctuations in the market, but maintains a positive outlook on its future potential, considering the current market conditions. We will present clips from Peter Krauth's interview with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Gold at all-time highs, silver barely at half of its all-time highs. And silver always lags gold. We know that. Gold is first, moves first. It's the king of precious metals. Always has been and always will be. I don't dispute that. But silver can provide better returns. It has more leverage. And as I say, it runs later, but it ultimately ends up catching up with gold and typically outperforms. We've seen that in nearly all bull markets since the 70s. Silver will catch up and outperform gold. Why is it, has it been facing overhead resistance? And I'm going to say that's probably been in the last 3 years or so, 3 to 3.5, 4 years. I had the sense that because we're facing structural deficits in the silver market, so your supply really comes from mining and from recycling, and then you've got what I call secondary supply, which is what typically sits at the futures exchanges, sits in silver ETFs, and the sort of third part of it is physical hoards. People who own silver sit on it. That could be personal investments. It could be strategic ownership. That could be larger investors. So you've got these three aspects. You've got, again, the silver futures exchanges, the ETFs, and then you've got these private hoards of silver. And I kept thinking to myself, well, if there's a structural deficit and the price is not moving, these large consumers, especially on the industrial side, which has now moved to about 60% of the silver market is industrial consumption. These consumers are getting it somewhere. And I started doing some research looking at the inventories the three major exchanges, the COMEX, the LBMA, the Shanghai. and the silver ETFs. And over the last 3 to 4 years, all of them are down. Their inventories are down 30 to 40%. And if you look at what they call registered silver at the futures exchanges, the registered silver is what is actually silver available for delivery. And that silver is down 70%. So my conclusion is that this is where the large consumers have been getting their silver, and he, in that kind of environment, not pushing silver prices higher because they've been sort of soaking up this secondary supply that's just sitting there. So I think that they're buying long futures contracts, waiting for them to mature, taking delivery, buying silver ETFs. They're allowed, if you own certain ETFs and you own enough of those ETFs, you can actually go to the manager and say, I want to turn my units into physical silver, and here's the address. I want delivery. So I believe that's what they've been doing. They've been fulfilling their requirements through these means, and it's helped to keep a cap on the price. So how long can this last? So that's sort of the next phase of it, or the next part of it. I think just, given how much these inventories have come down and the rate of growth in demand, both from investment and from industry, I think we're anywhere from 12 to 24 months ish, where, if this kind of soaking up and draining of these inventories continues, that we're going to reach a point where the inventories are essentially empty, other than perhaps the personal physical hoards. And interestingly enough, there was a report by TD Bank just recently that said nearly identically the same thing. They see anywhere from 12 to 24 months where this can continue, and then the game is over, and we will have essentially run out of this kind of secondary silver.
The recent surge in silver prices is closely tied to the growing significance of the solar industry, where silver plays a vital role in powering photovoltaic cells. Bloomberg NEF's projections indicate a substantial increase in silver demand for solar panels, with estimates suggesting a surge of almost 169% by 2030. This surge, equivalent to around 273 million ounces of silver, represents a significant portion of the total silver demand projected for the future. As a result, the demand for silver has spiked, especially considering its crucial role, accounting for roughly 20% of total silver consumption. China's dominance in solar panel production further underscores the reliance on silver, as the country controls a massive 80% share of the market. However, despite the growing demand, the supply side of the silver market faces notable challenges. Despite efforts to explore various sources, including traditional mining and investment avenues like futures markets and ETFs, the supply of silver struggles to match the soaring demand. One key reason for this discrepancy, highlighted by Peter, is the lack of investment in exploration and mining capital expenditure in recent years. Mining companies, influenced by factors such as low commodity prices and investor pressure, have reduced spending on exploration projects. Consequently, the shortage of new silver mines exacerbates the supply-demand gap, further driving up silver prices. Let's get back to the interview.
I think that because solar has become such a driving force in the silver market, with now representing about 20% of all silver consumption, just going to the one application of solar panels, and China controlling 80% of that production of solar panels. I think that they really absolutely need it. They're not getting it as well as they may try in all the possible sources, offtake agreements, whatever they may have, even going to these futures markets, going to the silver ETFs. They have domestic production. It's just not enough for them. So the market is very tight. This is anecdotal, but I have reason to, believe it and take it very seriously. And I just think that the mine supply is not going to react very much at all over the next couple of years. I just don't see it. We have not found much, if any, new silver mines. There's not much being spent on exploration. General mining capex is at decades lows. We've been through a bear market in commodities uh, where the mining companies have pulled in their reins, have cut spending dramatically. The capex has not been there to support higher demand. So what happens is, and we saw it in the last resource bull market, is that demand builds up, stays high, stays sustained high, and it stays there for a while as I guess these conservative or newly conservative, perhaps, mining CEOs see this and say, "Okay, we need to start reacting to this. We need to start spending on exploration. We need to start spending on capex to build our mines out." And then eventually it catches up, but that could take 5 to 10 years. Finding a mine these days, just from discovery to growing the resource to getting it permitted, financed, building it can be anywhere from 10 to 15 years. And different jurisdictions, start to become more difficult or less friendly to some of these projects. So I think that it could take really some time to play out for supply to catch up. And we've seen the primary silver miners do not see it happening. Where you could have some reaction in terms of supply, I think, is probably more than anything. I don't think recycling will be an answer for it either. Is going to be, if anything, on the physical investment side, where you have dishoarding, people selling back into the market. Um, I don't think that's going to be a huge thing either, especially if we're in an inflationary environment, which I think we will continue to be. And so in that kind of environment, at $35, $40, chances are you will have some people selling back into the market and helping to boost physical supply. That may alleviate it a little bit. But then on the other hand, you've got buyers of physical silver who see the inflationary environment and say to themselves, well, I'll take that silver. You're selling it off into the market. I'll happily take it off of your hands and paying higher than normal premiums even these days for it. So, reaction from supply, all angles of supply, I really see as quite minimal. And so the only answer is higher silver prices, really. And even still, not much supply reaction with higher silver prices. So that's, amongst probably the surest bets in the market right now. There's almost nothing that is more undervalued. You'd be really hard pressed, I think, to find anything across the markets that is more undervalued and better value than silver and silver stocks at this point.
As the silver market continues to show positive momentum, surpassing the $28 barrier, the outlook for the future appears promising. Peter's prediction of silver prices potentially reaching $30 or beyond by the year's end adds further fuel to this optimistic forecast. Driven by robust market dynamics and increasing demand, silver's bullish trend is expected to persist. Share your thoughts on Peter's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.